Gold and silver are repricing fast, and this is not happening in a vacuum. It is happening because war risk is no longer a background headline. It is moving into the core of the global economy. Energy routes are under pressure. Shipping costs are unstable. Insurance risk is rising. Governments are spending more, borrowing more, and preparing for a world that suddenly looks far less predictable. And when the world stops trusting stability, money starts looking for shelter. That is why gold is moving. That is why silver is waking up. And that is why this story matters right now. What the market is trying to price in is not just one conflict, one missile strike, or one scary weekend headline. It is trying to price in a new environment. An environment where supply chains can break faster, where commodity shocks can return without warning, where inflation can re-accelerate even when central banks claim it is under control, and where investors are beginning to realize that the old playbook may not work in the next phase. Gold and silver are not just reacting to fear, they are reacting to a much bigger repricing of risk. And that is where most people still get this wrong. They look at gold and think fear trade. They look at silver and think volatile metal with mood swings. They assume these moves are emotional, temporary, and driven by headlines that will eventually cool down. But what if this is not a panic spike? What if this is a structural reset? What if the metals market is beginning to reflect something deeper about debt, currencies, war spending, and the fragility of the global system itself? Because once war risk enters the economic equation, everything changes. Start with energy. When military tension rises in critical regions, the first fear is not always the battlefield itself. It is the choke points, oil routes, gas routes, shipping lanes, refining infrastructure, storage terminals, pipelines, ports. The modern economy runs on a tightly connected energy web, and that web is more fragile than it looks when markets are calm. The moment traders believe supply could be interrupted, even briefly, prices respond. And higher energy prices do not stay in one corner of the economy. They spread into transport, into food, into manufacturing, into electricity, into consumer prices, into inflation expectations. Suddenly, the central bank story gets messy again. Now think about what that does to gold. Gold does not need chaos to rise, but chaos accelerates every argument in gold's favor. If inflation risk rises, gold benefits. If real yields become unstable, gold benefits. If trust in paper assets weakens, gold benefits. If governments respond to war risk with more spending and more deficits, gold benefits again. This is why gold can move before the public fully understands what is happening. It senses the policy response before the policy response is announced. And silver sits right behind it, but with a completely different personality. Silver is part monetary metal, part industrial metal, which means it reacts to two worlds at the same time. On one side, it moves with gold when investors want protection from monetary disorder. On the other side, it carries exposure to manufacturing, electronics, solar, defense applications, and the broader industrial cycle. That combination makes silver dangerous in both directions. When markets are confused, it can lag. But when the market finally sees both inflation risk and supply stress at once, silver can start moving much faster than most people expect. That is why silver repricing is so important here. Because if the market were only pricing a temporary fear burst, gold could rise alone while silver stays sleepy. But when both metals begin to revalue quickly, it hints that the market is no longer focused only on safe haven demand. It may also be anticipating a wider commodity problem, a wider currency problem, a wider confidence problem. And once those layers begin to stack on top of each other, the move stops looking random. It starts looking logical. Look at how global economies behave in periods of rising military tension. Governments do not suddenly become fiscally disciplined. They do the opposite. They spend, they subsidize, they support allies, they expand procurement, they backstop energy markets, they protect domestic industries, they build inventories, they issue debt, they promise stability using money they do not have. That response may be politically necessary, but economically it creates a contradiction. The state tries to calm the public while quietly increasing the monetary and fiscal pressure beneath the system, and markets eventually notice. This is where the repricing becomes more than a reaction to war. It becomes a reaction to what war exposes. It exposes how dependent the global economy is on cheap energy, cheap shipping, cheap capital, and predictable trade. It exposes how vulnerable supply chains remain even after years of supposed diversification. It exposes how difficult it is for central banks to fight inflation when governments are running strategic spending programs at the same time. And it exposes one more thing that matters a lot for gold and silver. It exposes weakness in fiat confidence. Because the average investor may not say it that way, but that is what happens when people rotate toward hard assets. They may call it hedging. They may call it uncertainty management. They may call it portfolio insurance. But under the surface, they are responding to the same fear. The fear that paper promises are becoming less reliable at the exact moment the world is becoming more unstable. And instability changes behavior faster than economists like to admit. Corporations begin locking in inputs earlier. Funds start increasing commodity exposure. Wealth managers talk more about diversification. Central banks keep accumulating reserves. Retail investors who ignored metals for years suddenly start paying attention. And once that demand shift begins, it can feed on itself. Because higher prices create visibility. Visibility creates headlines. Headlines create curiosity. Curiosity creates late buyers. And late buyers can turn a rational repricing into an emotional rush very quickly. But before that happens, there is usually a stage where the market still underestimates the move. That may be where we are now. Because many people still treat war risk as a short-term shock that fades once the next diplomatic headline appears. They are assuming the world can go back to the pre-tension baseline. But what if the baseline has already changed? What if insurance premiums stay higher? What if shipping remains less efficient? What if governments keep strategic stockpiles larger? What if energy insecurity becomes a permanent feature rather than a temporary scare? That would mean the global economy is entering a structurally more expensive era. And structurally more expensive eras are exactly the kind of environment where gold and silver stop looking optional. This is also why the move in metals can become self-reinforcing. If war risk pushes oil higher, inflation fears rise. If inflation fears rise, rate cut expectations get distorted. If rate expectations get distorted, bond markets become less stable. If bonds become less stable, investors lose confidence in the traditional safety asset mix. And if the traditional safety mix becomes less reliable, gold attracts even more capital. Then silver, with its smaller market and higher volatility, can start to accelerate even harder. That is the sequence many investors miss. They think gold moves first, then the story is over. In reality, gold often sends the early signal. Silver can become the later confirmation. And when silver confirms, the message is often broader than fear. It suggests the market is beginning to price a larger regime shift. Now add another layer. War risk does not only threaten energy, it can also disrupt mining, refining, transport security, industrial demand patterns, currency flows, and investor psychology across regions. Precious metals do not trade in isolation from those channels. If producers face higher input costs, that affects supply. If diesel gets more expensive, mining gets more expensive. If transport becomes riskier, delivery becomes more expensive. If capital becomes cautious, new projects get delayed. All of that matters because metals markets are often tighter than they appear on the surface, which means repricing can happen faster than the public expects. And once it begins, the narrative usually changes after the price move, not before it. That is one of the most important lessons in this entire story. People want a clean explanation before they act. Markets do not wait for clean explanations. They move when enough participants believe the old price no longer reflects the new reality. The explanation comes later, after the chart has already changed, after analysts rewrite their notes, after commentators start calling the move obvious. But in real time, it never feels obvious. It feels confusing. It feels overdone. It feels like maybe you missed something. That is exactly why repricing catches so many people off guard, especially in silver. Because silver has a way of looking unimportant right before it becomes impossible to ignore. It can sleep through the early phase. It can frustrate bulls. It can fake weakness. Then suddenly it starts doing what small, thin, emotionally neglected markets do when capital finally shows up. It moves in larger percentages. It gaps. It squeezes. It drags attention back toward the whole sector. And by the time mainstream investors start asking whether silver is too expensive, the real move is often already underway. That is what makes this moment so interesting. Gold is not rising in a world of calm growth and healthy disinflation. Silver is not waking up in a world of perfect supply chains and falling geopolitical tension. These moves are taking place while the global economy is facing layered risk: war risk, debt risk, inflation risk, policy risk, energy risk, and above all, trust risk. The trust that inflation will stay contained, the trust that global trade will remain efficient, the trust that governments can spend aggressively without consequence, the trust that central banks still control the narrative. What if they do not? What if the market is slowly realizing that the next inflation wave may not come from consumer exuberance or post-pandemic distortions? What if it comes from conflict, energy, logistics, industrial policy, and fiscal reaction? That would be a much harder form of inflation to fight, a more political form, a more persistent form, a form that central banks cannot easily solve with a few speeches and a well-timed pause. And if that is the inflation ahead, then gold and silver are not just moving because people are scared. They are moving because money is adapting. That distinction matters. Fear spikes can reverse quickly. Adaptation trends can last much longer. If portfolios are being restructured for a world of more persistent geopolitical fragmentation, then precious metals may be entering a stronger phase than many expect. Not because every day will be green, not because volatility disappears, but because the reasons to own them start multiplying instead of fading. And that brings us to the hidden risk most people still are not pricing properly. What happens if war risk hits the global economy at the same time growth slows? That is the nightmare mix. Slow growth with stubborn inflation pressure, weak consumption with elevated energy costs, fragile business confidence with rising sovereign spending. In other words, a modern stagflation scare. If that word starts returning to mainstream discussion, precious metals move from niche asset to mainstream defense. Gold in that environment becomes more than a hedge. It becomes an alternative trust anchor. Silver becomes both a hedge and a speculation on the intensity of the next commodity cycle. And stagflation is exactly the kind of theme that can keep repricing alive long after the first headlines cool. Because then the market is no longer asking one question, it is asking five. Can central banks cut if inflation reaccelerates? Can governments fund new spending without pressuring bond markets? Can energy stay contained if trade routes remain exposed? Can equities maintain high valuations if macro uncertainty keeps rising? And where does capital go if both stocks and bonds become more complicated? That last question is where gold and silver keep entering the frame, not as a relic, not as a panic toy, as a response to policy confusion. That is also why central bank activity matters so much in the background. When official institutions accumulate gold, they are not doing it because of social media excitement. They are doing it because reserve diversification matters more in an unstable world. They understand that geopolitical fragmentation changes how countries think about settlement risk, currency exposure, and strategic independence. Private investors may chase price. States chase optionality. And right now, optionality is worth more than it was a few years ago. Silver does not get the same central bank bid, but it benefits from the broader psychological shift. When gold gains legitimacy, silver gains attention. When gold breaks to new zones, silver stops being ignored. And when silver stops being ignored in a risk-driven macro environment, the upside can become violent, because the market is much smaller and much thinner. That is where repricing can turn into acceleration. But acceleration always comes with a test. The test is volatility. Can investors hold through sharp pullbacks? Can they understand the bigger thesis when the market throws a sudden red day at them? Can they distinguish between noise and a genuine break in the underlying logic? Because metals almost never move in a straight line. They move in waves. They shake out weak hands. They punish late entry and emotional decision-making. And that is especially true when the catalyst is geopolitical tension, because headlines can change by the hour, even when the structural issue remains the same. So the real opportunity may not belong to the fastest trader. It may belong to the investor who correctly sees what is being repriced. War risk is forcing a reassessment of inflation. Inflation risk is forcing a reassessment of rates. Rate uncertainty is forcing a reassessment of traditional portfolios. And that entire chain is forcing a reassessment of hard assets. Gold is at the center of that reassessment. Silver is the levered expression of it. That does not guarantee a straight path higher, but it does explain why the move can be deeper, broader, and more durable than the average headline summary suggests. And there is still one more layer that cannot be ignored: psychology. Markets can tolerate bad news when bad news is familiar. They struggle when bad news starts compounding across systems. One conflict is one thing. Conflict plus inflation risk is another. Add debt pressure, fragile growth, and unstable energy flows, and suddenly investors are not just reacting to an event. They are reacting to a worldview shift. A shift from assuming resilience to questioning resilience. from trusting stabilization to doubting stabilization, from believing the system will smoothly absorb shocks to wondering whether the shocks are now too frequent and too interconnected. That is fertile ground for precious metals. Because gold and silver do not need the system to collapse. They only need confidence in the system to weaken enough that alternatives become attractive. And confidence usually weakens gradually, then suddenly. First, the experts say things are manageable. Then they say risks are elevated. Then they say conditions are fluid. Then one day the price chart is far above where most people thought it could go, and the explanation suddenly becomes obvious in hindsight. That is how repricing works. And if this repricing continues, it could have consequences far beyond bullion charts. Mining equities may reawaken. Commodity-linked currencies may react. Bond markets may become more sensitive to fiscal headlines. Consumers may face a new round of price pressure if energy remains unstable. Equity sectors dependent on cheap financing and calm logistics may start to feel the strain. In other words, gold and silver may not just be telling a metals story. They may be signaling stress building across the broader financial architecture. That is why this is bigger than a rally. It is a message that the market is beginning to doubt the idea of a smooth global landing. A message that war risk is no longer local if it can travel through energy, trade, debt, and inflation. A message that the price of safety is going up because safety itself is becoming harder to find. And when the price of safety rises, precious metals tend to respond before consensus fully catches up. So where does that leave us now? It leaves us in a moment where gold and silver are moving fast for reasons that run deeper than fear alone. The market is starting to price a world with higher strategic tension, less policy flexibility, and greater sensitivity to shocks. Gold is benefiting because trust is getting more expensive. Silver is benefiting because the same world that wants monetary protection may also be walking into renewed industrial strain and commodity pressure. Together, they are flashing a warning that many still do not want to hear. The warning is simple. The global economy may be entering a harder phase, a phase where conflict is not just a headline, but a cost driver. A phase where central banks may have fewer clean options. A phase where debt matters more, inflation behaves worse, and traditional diversification feels less reliable than it did in the old cycle. If that is true, then gold and silver are not late. They may be among the earliest assets telling the truth about where the macro story is going next. And that is the real takeaway. This move is not only about war, it is about what war reveals. It reveals the fragility of confidence, the vulnerability of supply, the inflationary reflex of governments, and the growing appeal of assets that do not depend on political promises. Gold and silver are repricing fast because the world beneath them is changing fast. The charts are reacting to a deeper shift in trust, cost, and risk. Now the only question is how far that shift goes. Do you think this metals move is just a fear spike, or the start of a much bigger reset in the global economy? And between gold and silver, which one do you think has the stronger upside if war risk keeps rising? If you want more high-conviction finance breakdowns like this, subscribe and stay close, because the next phase of this story could move even faster than the first.